Good morning, everyone, and thank you for joining today's webinar covering the Federal Crop Insurance Program. My name is Natalie Collins, and I am the Manager of Member Relations for COG and will act as the moderator on today's call. With harvest recently wrapping up, it is now time to start planning for next year. An important part of your 2017 planning process is managing the risk of your crop. Presenting today will be Greg Merrill, Senior Vice President and Director of Crop Insurance Services with Pan American Insurance Agency. Since Pan American's founding in 1946, they have emerged as the premier provider of quality insurance products and services to California's wine industry. Since 1995, COG has endorsed Pan American to deliver competitive, quality insurance to our members with exceptional customer service. Greg, thank you very much for joining us today and sharing your knowledge on crop insurance with our members. So now real quick, I want to go over the format of the webinar. We will begin with a 20 to 30 minute presentation and then open it up for Q&A. Please feel free to type and submit your questions as we go, and all questions are anonymous, so I will not use your name when reading them. This webinar will also be recorded, so I will send everybody a link later on today. I will also want to remind all COG members on the line that if you have any further questions after this webinar on any form of insurance, please contact Greg with Pan American and he will be able to further assist you. So now without further delay, I would like to turn the presentation over to Greg.
Thank you, Natalie, and welcome everybody. We will try to be conscious of time and cruise through this topic at a good pace, and then obviously open up for questions. And all my contact information is there in front of you, so if there's additional questions at a later time, as Natalie mentioned, please feel free to reach out, and we'll be glad to help you out. So without further delay, this is the COG-endorsed Federal Crop Insurance Program, and obviously, specifically, we will only be talking about how that's applicable to wine grapes. So why consider crop insurance? The first question when talking about your business assets, when talking about liability, etc., is managing your risk. Every business has risk, whether it's the potential for slip and fall or workers' compensation type claims, and what folks often overlook is their growing asset, which would be wine grapes, and not necessarily realizing that there is a very quality type of coverage out there, the Federal Crop Insurance Program, to help manage any risk associated with your growing crops. This is indeed the only coverage available for growing crops. Note that it is not coverage for the trees or vines, and trees obviously thinking about things like almonds or pistachios. So if your vines are damaged in the case of wine grapes, this coverage is not going to apply. This is just for the crop itself. This is an insurance program that is part of the Farm Bill, and as such, it does have a subsidy component. The feds subsidize a portion, or in some cases all, of the premium for these policies. We would all love to have that with our auto insurance or our homeowners or our property or our general liability. This is the only insurance program that I'm aware of that has this type of federal subsidy involved. It is easy to sign up. It's also easy to maintain your coverage. We'll talk a little bit about that. In some cases, crop insurance is required in order to be eligible for future or other USDA programs. The main one there would be is if a county is declared a disaster county for some reason, and there's some additional government USDA program coming in to provide help to a disaster county. One of the first questions they're going to ask you likely is, do you have crop insurance? Did you have crop insurance? And at what coverage level? One other thing to note is it is a fixed price insurance program. So whether you obtain your coverage through Pan American or through another agency, the pricing should be exactly the same, identical down to the penny. And if it's not for some reason, then there's a problem. So note that it's a fixed price program. So crop insurance is a great way to manage your risk. For wine grapes, first thing you would need to determine is if you're insurable. If you're considering a policy, the couple components you want to look at is if the vines are fourth leaf if they were planted, third leaf if they were grafted. And the way that that works is you count the year of insurability and count backwards by that number of leaf years. So for 2017, we would, for planted, and sorry there's a little typo there, for planted, you would count back 4 years, so you'd count 17, 16, 15, 14. So if they were planted in the first half of 2014, you would be eligible for 2017 crop year. For grafted, third leaf, you would count backwards again. You're going 17, 16, 15, grafted in the first half of 15. They would meet the age requirement. The other requirement is a production requirement, and that says that the vines have to have produced over 2 tons or 2 tons or more per acre in one of the prior 3 crop years. Something to think about here is you have multiple varietals, likely your Cabernet, your Chardonnay, Pinot Noir, and maybe one has met the age and production requirement, but the other 2 have met the age but not the production requirement. You do have the ability to insure by varietal based on those varietals becoming insurable or not. If the above requirements are not met, and that's mainly pointing to the 2 tons per acre, we can make a request to the carrier to approve insurability. What they're going to need to do is an inspection and have some discussions with you as a insured or as a grower to determine if they may be able to wiggle around some of these requirements. Each case is very specific though, so no guarantee of insurability unless these requirements are met. Once they are insured, what are they insured for? The insured causes of loss are all listed here. Adverse weather conditions, we put first and just try to boil it down and simplify it to that, to say it does not have to be some major frost, freeze, hail, major rain right at the time of harvest that just knocks everything out and ruins the crop. It could be any combination or accumulation of various causes of loss that ultimately add up to damage significant enough to have a payable claim. So adverse weather conditions, earthquake, fire, if caused by an insured peril. Why we mention that is because it needs to be caused by a natural peril. Arson is not necessarily a covered cause of loss for the federal crop insurance program. Wildfire, again, that's going back to a natural occurrence and cause. Failure of irrigation water supply, again, if caused by an insured peril. One thing that could happen there would be earthquake that potentially disrupts the water supply, drought that ultimately reduces your water supply to 0. A note there would be if it is a regulatory authority that cuts off your water, that is not necessarily a covered cause of loss because that's not a natural peril, that would be a man-made situation. And then insects and disease, one exclusion would be phylloxera. Problem, so I apologize for that, and just yell at me if I'm cutting out again. So we touched on the left side there related to coverage levels, the various coverage levels that are available, and hopefully you could hear me. Basically all of those percentages on the left side are the percentage of the crop that the policy would protect for your average crop. On the right side, there is a little matrix there that shows you by coverage level the amount of premium that is covered by the federal government. So at the catastrophic level, they actually pay 100% of the premium. And as you go down the list there, you can see the various subsidies, and again, that's the portion that the feds are paying. The second component is price election. So the first component, coverage level, second component, price election, and this is the percent of the price you're paid at the time of loss. And what that really means is if you are in a claims situation, by each county and also for each varietal, there is a certain dollar amount that you would get paid for per ton of grapes. And in Napa County, that let's pick Cabernet Sauvignon, and we're going to hit on that in a few slides here as well. For 2017, that price is $5,895. And essentially, you can boil price selection down to really two categories if you look at the third and fourth bullet points there. Under catastrophic coverage, you would only get 55% of the price per ton in the county if you had the catastrophic coverage. So that same $5,895 for Cabernet in Napa County at 55% is $3,242 per ton if you were in a claim situation. At the buy-up coverage levels, generally everybody selects the 100% price selection. There are a couple variables in there where you could buy down that price. In all of our clients that we have, that has essentially never been done, but it is an option. So we typically just say the buy-up price selection is 100%. So if that same grower was in a claim situation, they would receive $5,895 per ton. Again, that's Cabernet in Napa County. So how does it work? One way to look at the the policy is really just to look at a claims example, and we try to boil it down to make it fairly simple here. In this case, we have a grower with 100 acres of Cabernet Sauvignon in Napa County who averages 4 tons per acre and has CAT coverage, catastrophic coverage. Remember, that has a 50% coverage level and a 55% price election. During harvest, and we're just picking a an extreme kind of scenario here to say, hey, the total crop was lost, but in this case, extreme moisture damages the crop. They were able to harvest, but ultimately it was determined to be a total loss. What is the potential claim payment? Well, this grower and you can kind of look into the parentheses there, it gives some of the math behind it all. It's in the smaller font. 100 acres times 4 tons per acre, that would equal 400 tons, times a 50% coverage level equals 200 tons guaranteed. So this policy guarantees them, if they have a total loss, 200 tons. Then the price election, $5,895 is the county price for Cabernet in Napa, times the 55% price election, which is the price election for catastrophic coverage, results in a per ton payment of $3,242.25. The simple math there results in a potential claim payment of $648,450. How much did this policy cost? Technically, in terms of premium, it cost $0. However, the feds do tack on a $300 federal administration fee to this policy. So the net cost out of the grower's pocket is $300. Behind the scenes, the premium that was federally subsidized essentially would, I believe ran this quote this last week, would be $9,200. So in this policy, the feds are paying $9,200 on your behalf in terms of premium. Now, similar coverage example, but this is a buy-up level of coverage. Same grower, 100 acres, 4 tons per acre average, Napa County, but here they have what we would call the 60/100 coverage level. That means they have a 60% coverage level with a 100% price election. During harvest, same scenario. Basically, the crop was ultimately gone through to be harvested, although it was determined to be a total loss as a result. What was the potential claim payment? In this case, there's 240 tons guaranteed, and you see the math there, 100 acres times 4 tons per acre times the 60% coverage level, and then the price selection, $5,895 for the county. Now they're getting 100% of the price. So if there was a total loss, total liability loss on this policy, they would receive basically about $1.4 million. How much did the policy cost? Ran these numbers as well. The premium paid by this grower would have been $10,653, and then the feds take the administration fee down from $300 down to $30. The premium, for buy-up coverage, it does vary. So it's based on acres, approved yield, the crush district that you are in, various options on the policy, and then of course the price per ton. The actual premium, what we call the base premium for this policy, behind the scenes would be $29,592. The subsidized portion of that, basically that the feds pay on your behalf for this grower, would be $18,939. One thing to consider, if you leave any portion of your vineyard unharvested, the policy will deduct on a per ton basis the following amounts based on the area that you are growing in. And so you can see here in the North Coast counties, they're going to deduct $200 per ton if you leave a portion of your vineyard unharvested. That portion would be assessed this penalty. And what I'll do is just briefly go through this. This is that same grower with the buy-up coverage, 60%, 100% price election, same scenario, but only 50 of the acres were harvested and gone through. Still, the crop was destroyed, but they stopped halfway and said, we're not going to go on, we're not going to harvest the rest of this because we're just realizing this crop is done. And so the way that I would shake out is the first 50 acres would receive the normal claim payment at the full price per ton, $5,895. The second 50 acres would have a reduced price. This is Napa County, so they take off $200 per ton, and they would receive a slightly reduced claim payment. In this case here, by not going through and picking as much as they could, or trying to, in the additional 50 acres, they lost about $24,000 in the claim payment. Claims. Report damage immediately. And on our side, we call that a notice of loss or a notice of probable loss. What that really means is whether naturally occurring peril event took place. It could have been mild, it could have been severe, but something went wrong. And what I tell a lot of my growers is, if you could picture your ideal growing season, everything's just great and perfect and goes well, picture that if at any time during 2017 it deviates from that ideal growing season, then you have a potential cause of loss, as long as it's a naturally occurring weather-related type of peril. So when we receive a call or an email from our growers, the two main things we need to know right away is the potential cause of loss, so maybe it's frost or freeze or sunburn, and then the approximate date of loss as well. So at bloom, and the date of that was just pick May this or April that, or just depending on the varietal when that takes place. We need to know those two things in order for us to submit a notice of loss to the carrier on your behalf. From there, an adjuster will be in contact. The claim ultimately gets deferred until harvest, and typically between those two bullet points there, the adjuster wouldn't just call you. They would want to come out and take a look at what's going on, take a look and inspect the crop and see it for themselves. And then after harvest, you as a grower are required and responsible to provide weight tags for your harvest. And those would be also identified as third-party records. So we have seen winery printouts and sheets, etc., but ultimately it needs to be something from a third-party weight master type certificate that certifies the tonnage that was ultimately received. Then the claim would be paid based on how many tons you were below the guarantees of your policy. One very important thing to note is that it's important to realize that claims filed beyond 60 days after harvest ultimately will and should be denied. We say harvest, there's also another date in there, which is the 10th of November, 60 days, and that's really the end of insurance for the policy. And if it's 60 days after that date as well, that puts you in jeopardy of your claim ultimately being denied by the carrier. 4 important dates. One would be, when do I sign up? We'd call that the application date, the sign-up date, and every single year that's January 31st. Now that's not just for, hey, I need a new policy. That's for the renewals as well of your policy to make changes, to maybe your entity changed from a partnership to an LLC and you need to amend that and make that change. Ownership changes, coverage level changes, adding a new varietal, those sort of things. Next date would be production reporting date. By that date of March 15th, we would need to receive your prior year's production. So we collect all the tonnage from the insurable acreage and we load that into the policy, ultimately to develop your approved yields for the policy. Then the final date is May 15th for acreage reporting. What takes place at that date is if you have, say, pulled out some vineyards in the early spring, something needed to come out for redevelopment, you have until May 15th to make that change to your policy. If it goes beyond that date and you pull something out, the policy actually has to stand as it was originally written, and that acreage would be included in the policy even if it was pulled out. So always think May 15th for that final acreage determination for your policy. And then also, if you're going to insure to your contract pricing per ton, and actually we're going to talk about that in just a second, a copy of your current contract with the winery is due also by May 15th. Premium billing date is August 15th. That's not when it's due. It's an interesting thing with crop insurance because they bill you after the fact. They don't bill you like car insurance, property insurance, etc. prior to the policy or at the beginning of the policy. They bill you towards the end of the policy. The bills get generated around August 15th. They are due by September 30th. A few quick items here. Contract pricing. You do have the ability to insure up to 2 times the federal price per ton with a winery contract. In that case of the Cabernet in Napa County, if you took that $5,895 per ton, multiplied that times 2, if my math is all correct, you could insure up to $11,790 per ton if you do have a winery contract that substantiates that. The contract price option must be selected when signing up, and the winery contract must be received again by that acreage reporting date of May 15th. One thing also to consider is if you have a vineyard, say, in the county, on one side of the county and it's Chardonnay, and on the other side of the county, and I'm saying there's distance between them or non-contiguous vineyards, they're not touching, you can insure those in what's called optional units at the buy-up coverage level only. So one has standalone for insurance and the other stands alone for insurance only if they are non-contiguous. Also, areas or ways that your blocks, if they're the same varietal, can be broken out would be if there's different share arrangements. Maybe you have a share relationship on one with a certain partner or landlord, and then on another block it's a different landlord and different share arrangement. There's considerations to be made there. Another item would be conventional growing, transitional organic, and fully organic blocks. We do break those out, and there's consideration made for those different types of growing practices. Some folks need coverage because their bank requires it. And what we would and can do is what's called an assignment of indemnity, which essentially provides proof of crop insurance to your lender and also assigns any payments of claims to them if it's needed per the terms of your financing agreement. one other item, what we call appraisals. If you are ever going to have a cultural practice where you're going to drop, an inordinate amount of fruit or abandon it for the year, something that's really going to take your production way down, but ultimately you're reducing good fruit, you can and should call us, in which case we would get in touch with the carrier. Carrier would come out before you do that drop and appraise the fruit and determine how much fruit was on the vine, such that we can use that number to plug into your production history database, and ultimately that would help your yield throughout the production history, rather than getting a 0 if you just dropped the fruit and there was no production. So always keep in mind, if you have any questions regarding appraisals, call us, call your agent to figure out how to address that. That is it. We're right on the 30-minute mark. Just a very kind of brief and basic coverage review, and apologize for the technical difficulties there in the middle. All our contact info is there. You can reach out to us. Do note that January 31st is the first deadline that is approaching. And there, John Aguirre, Why Pan American, really it comes down to relationship, and we've partnered with COG for a long time to bring valuable service and support to the association, and we hope that's mutually beneficial to all the grower members. So with that, Natalie, still there on the line?
I am. Greg, thank you very much for your presentation. We would like to open it up to anyone with questions for Greg. If you do not answer or ask the questions on the line, Greg's information is there, and he's open to any kind of calls or questions you may have after the presentation. So Greg, we do have one question here. It says, I've heard that if I don't pay my bill on time, that there could be consequences.
Yep. Yeah, so the kind of two consequences. I mentioned that the bills get generated on August 15th and they're due and payable by September the 30th. If you miss that deadline, they're going to send you another bill, and they're required by the program to tack on a very minimal amount of interest. So then your next bill is going to be your prior bill plus some interest. If that goes beyond the next month, they're going to tack on a little more interest and a little more and a little more. There is a stopping point, however, and that would be January 31st of that year. So for growers who had coverage in 16, the very last date for them to postmark their bill is January 31st of 2017. If they don't, and this would be kind of the second consequence, if they don't do that, they would be placed on what's called the ineligible tracking system list with the USDA, which really, really hurts. It makes you ineligible for essentially any USDA-related programs. Also makes you ineligible for crop insurance in the future until you make it right. So you definitely want to make sure, if you're signing up and you have a policy, that you're paying your bill timely to avoid those consequences.
Perfect. Thank you, Greg. Looks like we do have one other question in regards to smoke taint. So they're asking, how do claims with smoke taint work from wildfire?
Yep. So very, very particular type of claim. One thing you need to consider, and I'm going to try to stay fairly basic on this question, and maybe there's kind of a future communication that we could put out with regards to this topic as we get into the season next year. A smoke taint claim has to be inspected in the field, where the adjuster will come out and sample and test the grapes while they're in the field in order to determine if there's the appropriate or elevated levels of certain chemicals inside the grapes, and there's kind of some benchmarking related to that in order to say, yes, these do have smoke taint, and therefore there's a problem, and therefore maybe there is a resulting claim payment. but it has to be done in the field. That's the most important part. There's a little more nuance to a smoke taint claim than a standard, frost, sunburn, moisture type of claim, which are a little more cut and dry. But essentially, there is potential for coverage related to that.
Perfect. Thank you, Greg. Are there any other questions today? Okay, if not, this will conclude our webinar on crop insurance. Once again, I will send everybody the recording of today's webinar. And if you do have any questions, please contact Greg.
Thank you very much.
Thank you, everybody.
Take care. Bye-bye.